Here's why Silicon Valley Bank collapsed and what it means for startups. Silicon Valley Bank, a California-based lender that had catered to the tech industry for the last 3 decades, collapsed late last week after it suffered a good old-fashioned bank run. A bank run, for those who don't know, is when a ton of customers withdraw their deposits over fears of the institution's solvency. The SVB bank run was, in some ways, years in the making. During the pandemic, when interest rates were near zero, SVB invested in US Treasury securities. But when interest rates shot up in 2022 and 2023, the value of those securities plummeted. When the bank announced recently that it had taken a $1.8 billion hit on the sale of some of those securities, a number of big VC firms advised their companies to pull their money from the bank. So all those withdrawals, together with the investment losses, meant that California regulators had to step in and shut the bank down, which usually means liquidating the bank's assets to pay back depositors and creditors. Then, on Sunday, FDIC, together with the Treasury and the Federal Reserve, said they would make sure all SVB depositors were repaid in full. The government said it would even offer bank loans against their treasuries to treat them as though they were worth their original value, even though higher interest rates have decimated the value of the bonds. The government is trying to make a point. You can trust the banking system, and all your deposits are safe. But of course, not everyone is buying it. Major bank stocks have taken a tumble all week, and cryptocurrencies are once again surging. And there will be major ramifications for startups. Companies are now racing to create relationships with new banks, with customers and clients. And then in the long term, fundraising might become much more difficult for startups, since SVB was one of the top venture debt providers. If there's at least one silver lining, CEO of Brex, Enrique Dubagras, is apparently working on putting together over $1 billion in financing for companies that were impacted by the SVB collapse. So what's the bigger takeaway here? If there's an obvious lesson from the SVB collapse, it's that banks need to diversify. SVB became a giant by catering to venture capitalists and the companies they fund. But that also meant SVB was totally dependent on the health of the tech industry and on the whims of a small number of VCs and companies. So what do you think? Will other banks and Silicon Valley institutions learn from SVB's mistakes? Let us know what you think in the comments. Thanks for watching Fast News, and don't forget to like and subscribe.